Yep, yep.
Okay, well, welcome everyone to our live stream, and I hope you're all well. And a little bit of news to start with, and let me just wait until we've got a few more people on, and then I'll share this little nugget with you. So, the plan that we've got is to talk about cash flow modeling, but the reason why, okay, so what motivated this was some of our members asked if we could look at cash flow modeling tools, and Voyant is the one which is widely used. There's a UK version of Voyant, there's a US version, and I think there's one other country which they cover, maybe Australia. And the idea with these cash flow modeling tools is you enter certain details about what savings you have, and then assumptions about asset returns and inflation, and it knows about things like tax, and so you tell it your income as well, when you plan to retire, and if there are any known cash flows that are coming in future, you tell it about those as well. And then it goes off and it simulates the future and works out how much the cash flows you'll receive will be in future after you retire. And you can work out things like what if scenarios where if inflation's higher, what effect would it have on the outcomes? What salary could you withdraw safely without running out of money? Or, you know, if you save more, what impact is it going to have on your future savings and income after you retire? So it's a great way of modeling those things. You could do it with a spreadsheet, so that's always a possibility. And it's probably good exercise to do that first, so you realize what the problems are. But it does all of that for you. It knows about certain things like tax, about tax sheltered investments. So it's very, very kind of sophisticated from that point of view. And a lot of the wealth managers and many of the financial advisors use Voyant for their clients. So they produce the plan, they provide the plan to their clients in Voyant, which can then, you know, maybe play around with some of the numbers. So what we're offering is a way, and if you look in the description, you'll see this link to a video on Patreon, I believe, which is available to everyone. And in that, I talk about what Voyant is and also how to get a group license via us. Now, we don't make a lot of money with it. For us, you know, we're just trying to break even. I get a license out of it for a year. You've got to sign up for a year, and it's about 200 quid for a year. So you share the cost with us of our license, and we reduce the cost of the license to you. And if you just go for the software without any kind of group package, it would cost about £1,800, so 1,800 a year. So there is a substantial saving for all of us if we do that. So that's the plan. And if you're interested in cash flow modeling, which is probably a good idea because it's good to know what the future holds roughly, given what you've invested, then that might be a good way to go about it. And they've got very good videos on how to use it. So the support apparently is very good indeed. So that's what we're planning. And you're all welcome to have a look at that Patreon link, which is in the description. So that's the story about Voyant, and the video I've just done this week. I did a kind of extra today because we had an inflation spike and I wanted to just calm everyone's nerves because inflation was 4.2% in the US. We got a little equity sell-off as a result, mostly in tech. And so I just kind of dug into the numbers and just talked about the reason for the spike and what it might mean going forward. And then this Saturday, there's a video coming out where I talk about the very surprising fact, the shocking fact, that most stocks lose 100% of your investment over their lifetime, and why that's not necessarily a problem when it comes to investing, and why passive still works, and you know the chances of an active fund working. All interesting stuff. Anyway, so that's the video on Saturday. So welcome all to the live stream. Usual story, we have an hour. now 55 minutes because I've been blathering on. And if you could stop asking questions towards the end, maybe that's a good way to do this. But we'll answer questions from YouTube supporters first. And if you want to become a YouTube supporter, you can do it right now if you want to. And then your question will get pushed to the front of the queue and we'll very likely answer it. In fact, almost certainly answer it. If you're not a member, I'm afraid, we found recently that you don't get a look in. But if we do run out of member questions, then we will go to open the floor to everyone.
Super chat.
Or super chat is the other way of doing it. So obviously there you pay for the individual question. I see we've already got one from Maria DC. But thank you for that, Maria DC. But the other way to do that is via super chat. So it would be great if you do that as well, because it helps us, obviously, because it provides us with income. And you can always subscribe. And I should say, you can always follow us on Twitter, because we try and talk about some of the things we do, some of the content we've got, but also things we find interesting in terms of macro and in terms of markets. And we share those via YouTube. So I think that's quite a useful resource. And of course, it's free. So that's the intro. Let's start on the questions. You can always like this stream. Remember, that helps us and it costs you nothing. And share it with your via your own social media channels, because other people will then see that we've gone live. So let me just feed my dog, because he's realised that he's got treats. I think he's clued up to the fact that we've now got... Oh, very good. Look at you. He's gone bipedal. Excellent. Yeah, he's worked out that when we have YouTube lives, he gets treats. So he gets very excited about these. Almost as excited as me. Not quite. Right, so let's start with the questions. I think we've got some on Slack, haven't we, Laura?
Yes, 2.
Brilliant. So the first one is a super chat from Maria DC, which I mentioned earlier. Further to your video on a windfall. So this was one I did for members. So I guess Maria is a member of the PensionCraft community. Imagine you won 500k in the lottery tomorrow. Roughly any views on target percentage for global equity, specific sectors, EM, commodities, bonds, most importantly. Right. Okay. So now what's interesting about a windfall is, let's imagine for a moment that I didn't need the windfall, that I'd completely planned out all of my future pensions and I didn't need the money. And so I was confident that my future was taken care of. And yet I received this extra money, which I then had to invest. That's very different from someone who would need to use that for their actual pension savings, because I can take much more risk with that money if I've already set aside money which covers my future expenses. So if it was money I didn't need, then I'd go all in on risk. So what would I buy? A big part of it, I think, would be global equity. So probably that would be the vast majority of the investment, maybe, I don't know, 50% global equity, maybe 55, 60%. And then I'd put some money into higher risk investments. So that would be both in fixed income and in equity. Maybe I'd put a small amount into crypto, maybe 5% in crypto, especially now that it's sold off, thanks to Elon Musk. Then I put some into high yield credit, because there I think the risk premium could be considerable. Not at the moment. It's not a great investment at the moment because credit spreads are tight, but that would certainly be something I'd consider. And then on the equity front, I'd probably go for an EM overweight, and I might go for something like Cathie Wood's ARC funds. The reason for that is that I could afford to take the extra risk, and if the equity lost money, then I wouldn't really care, because I'd be investing it for a couple of decades. So certainly the kind of high risk end of the spectrum, maybe an emerging market overweight, maybe some thematic funds, which I like. So things like disruptive biomedical companies, that might be an interesting theme. Another theme I like is to do with robotics and AI. Maybe I'd put some into those themes. because there are thematic funds that you can buy that give you exposure to those, or also things like Scottish Mortgage, which always goes for those kind of themes, but then finds individual companies which it's continually changing. So, for example, Scottish Mortgage recently sold a large proportion of their stake in Tesla, and they've reinvested it into companies like Tencent and China. So they've moved money out of North America, some money out of North America, and put it more into China because they see greater opportunities to scale things in those countries. Whereas they don't really see such an opportunity to scale things like Amazon or Alphabet, which already pretty much are saturating their own markets. Plus they're facing these scaling issues, particularly antitrust lawsuits. So, they think they can scale growth in China much better. So maybe go for companies that they choose, or maybe go for funds like Scottish Mortgage, which are higher risk, but also potentially have higher reward because it's money I don't need. So that's what I do. It would be a kind of higher risk portfolio. And those are the kinds of things I might put into it. And then on the fixed income space, again, I might go for something like emerging market debt, because there occasionally you get completely hammered. But if I'm holding it for the next 20 years, then over that period of time, the average income might be 4 or 5%, which could give you a reasonable total return. So that's the kind of things I'd consider, certainly the higher risk end of the spectrum. Would I go for single stocks? Probably not, because I know I'm bad at choosing them. Okay. That's it. That's what I'd do. Dave says, another part to... another question. Okay. Further to your video... No. Oh, no, series. There's a second part. When you will invest on each of them, Q3, Q4, next year, wait for an event correction, imagine your time horizon is long, and not constraints on income needs. Yeah, so I do it straight away because, again, trying to time these things is not possible. So the evidence is pretty strong that you should try and put the money in as quickly as possible, because yes, you might get completely hammered, but if I'm investing for 20 years, a 20% fall will be invisible on the plot of returns over a 20-year period, assuming I go for an equity market investment which does fairly well, because then drift dominates over that period, and little blips at the beginning will be less significant over a long span of time. So yeah, 20 years I wouldn't care about crashes, and I certainly wouldn't sell if there was a crash. Next question from Dave C, who says, do you expect inflation in the UK to follow what we're currently seeing in the US? Yeah, because firstly, obviously, oil is part of the consumption basket for the UK, both directly via going to the petrol station, as we call it here in the UK, the gas station in the US, and we fill up our cars, but also indirectly because things have to be transported, food, goods, and that costs money because of the fuel costs. So if the fuel costs increase for haulage companies and for transportation, that can feed through to higher costs on other goods and services. So that's obviously going to be inflationary. And if you look at the latest US print of inflation, by far the biggest contribution is oil. So that's up about 50% versus the same time last year. And if you break down inflation into its components, that's the single biggest contributor to the rise in inflation. If you strip that out, the actual inflation rise is much smaller. The second biggest increase is due to the second-hand car market, which is kind of interesting. And I saw a really fascinating explanation of that, which is that if there's a chip shortage, then potentially that could squeeze the supply of new cars, because cars now require a lot of chips. So if you can't buy a new car, then you'll go to the second-hand car market. And also, we're coming out of lockdown. Maybe people put off their consumption or buying of a car during lockdown, and now they're thinking about getting a new car. That delayed purchase due to the pandemic, and in other words, pent up demand. So that's another component of inflation, which probably we'll see in the UK too. So, some of the things will be similar. So I think, the energy component will be important. The pent-up demand stuff will be important. Things like restaurants and salaries may be pushed up. So, for example, I just saw an article in the FT, I was just reading it just before this call, where they were talking about McDonald's in the US not being able to hire people, having to give people a sign-up bonus. And also for the McDonald's own stores, McDonald's owns about 500 stores and the rest are just franchises. For its own stores, it's going to raise salaries by 10% to try and get people to work for them. So I think that could be similar in the UK, where we're trying to hire staff, but many of the Eastern European staff have left the UK due to Brexit, and so it's hard to find employees. And the real sweetener is going to be raising wages. That's pretty much the only option, and that'll feed through to prices as well. So I think that will be inflationary, certainly in the near term. But again, I think a lot of this is transitory, and just as the Fed says, and I think it'll be transitory in the UK as well. So oil will be a base effect due to the prices being so low last year. The labour squeeze, again, I think it'll just be a matter of time until more people apply for those jobs and the competition for those jobs starts to increase. So maybe the wage increases will slow down or stop altogether or even reverse. So I think a lot of this stuff, like the supply bottlenecks as well, will be solved. So I think, 1 year of higher inflation maybe, and certainly the next 2 or 3 prints of inflation over the next two or 3 months, I'd expect inflation may surprise on the upside, but then I'd expect it to subside again. The bottlenecks are the ones which are less predictable. Those, are hard to predict because you can't say how quickly companies will fill the gap to increase supply if demand increases. Some of them may not even fill the gap if they feel it's not worthwhile. But I think that's going to resolve itself as well eventually. So, yeah, short-term spike and maybe 2 or 3 months, and then back to normal in the UK, just as the US. And generally, you do find inflation's fairly highly correlated across developed markets if you just plot that historically. Right, question from Arsenio. So please like our stream. You can do that whether you're watching live or whether you're watching this in a replay, because we know thousands of people do watch these in replay, and share it on Twitter, and check out the Voyant license that we're offering. If you've just joined us, then you'll see that we're producing an offer so that you can buy cash flow modeling software at a reduced price, a very fancy piece of software called Voyant. And if we all buy it together, then we can reduce the license fee considerably. So it'll be about £200 for a year's membership of Voyant. So you can simulate your future income if you invest in equity or whatever your investment portfolio. So yeah, check that out. It's in the description. And back to the next question from Arsenio. Shell and one swig. Shell and BP still have not recovered from the pandemic, and also today lost around 2%. Shouldn't the oil sector benefit from an increased prices due to inflation and expected higher demand? Certainly that's true. I think the headwind faced by that industry is a structural one. So let's imagine that you're the CEO of BP, and you can see the writing on the wall, and obviously the whole world is transitioning to renewables. Fossil fuels are running out, and so your industry is in structural decline. What do you do? Okay, this is like an agony aunt for the CEO of BP. Obviously, they'll be transitioning to a clean energy future. Now, they already have infrastructure whereby they can provide energy for cars, for example. So their forecourts at these petrol stations, gas stations, can be used as electricity recharging points. So that's one way they can do that, but it's going to cost a lot of money. So there's going to be massive drag on their margins, which are never that huge for oil companies anyway, or energy companies. So that's a problem. And then some of them might not make it. You know, if BP rebrands itself as a clean energy company, are people going to trust it, or they trust a shiny new company like Tesla, which has these charge points? It has its own network. So there's always the risk that the transition doesn't work, that it fails, and their company goes the way of Kodak and essentially passes into history and oblivion and becomes one of those 100% lost companies over its lifetime. That's the worry. So I think that's the headwind that these companies face. At the same time, as you say, you know, they've still got a few miles on the clock. We're still driving fossil fuel cars now, and the oil price is going up. Not hugely, I have to say, anymore. It is up, 49% on a year ago. But remember, the equity market will price that information about oil prices in very quickly, whereas inflation is really slow at picking up these year-on-year changes, because inflation is calculated year-on-year or month-to-month, but year-on-year is the way it's usually quoted. So that's why I think I wouldn't kind of read too much into a 2% move up or down, because remember that the volatility of a typical stock, daily volatility, is 2%. So a 2% move is no information. If it was a 4% move, that would be 2 standard deviations. That would be some kind of news driving it probably. And if it was a 6% move, yeah, you bet something's happened. But 2%, could just be noise. That's just typical market noise. So yeah, I think obviously if oil prices go up, it'll be good for the sector, but they face those structural headwinds and the drag on margins as they transition to clean energy. Okay, so back to the questions on here. Don't know if we've got any more questions from members. Don't think so. Oh, okay, so we'll go back to the questions from people who've asked. The Christian Haas says, another Thursday with Ramin. Yay, that's very kind of you. And Anton Belev, good evening. Paul F, good evening. Exciting week for markets, Anton says. Certainly true. What's the difference between... Okay, Multiform says, what's the difference between Vanguard Emerging Markets Stock Index Fund and Global Emerging Markets Fund? So let's have a look at those, just to show you how I think through these things. So let me just... I'll just share my screen in one moment. Let me just... find those first, and then I'll share my screen. Okay, and the Global Emerging Markets Fund. Now, what I suspect the difference is the legal wrapper for the two. Yeah. Let me just switch this one to accumulation. Right. So let me share my screen just to show you how I kind of look at this, because, then you'll be able to apply this knowledge when you compare funds in future. Right. So you should be able to see this. So here's the first one. So what would I look at? First thing, ongoing charge, number of stocks. So this has got 1,420 stocks. It's a passive fund. So let's see what it's tracking. This one's tracking the MSCI Emerging Markets Index. And this one, which is the Global Emerging Markets Fund, has much fewer stocks, so 167. The ongoing charge is 0.78. Oh, I wonder why. Well, that'll be because that's an active fund. So this is 0.23%, the passive one. The active one is 0.78%. And what Vanguard generally does is they farm out the management to active managers. They don't do it themselves. In this case, they've given it to Bailey Gifford, Oaktree Capital, and Zena Investment Management. So presumably they found managers which they trust, and they've done their due diligence, and they think they're worth the 0.78% for that fund. Notice that this is much more concentrated because active managers generally, to outperform, will concentrate their portfolio in the stocks that they think will outperform. And anyway, there are far fewer stocks in that. And if we look at the country exposure, so if we compare those two, you can see that for this active one, the China allocation is about 27%, a little bit less than I'd expect from market cap. So if we go to portfolio data for the passive one, yeah, so for here, the China exposure is about 38%, same as the MSCI EM benchmark. Taiwan 14%, Korea 13%, because ridiculously MSCI thinks South Korea is an emerging market. And if we look at this active one, looks like it's got a big underweight on China. And you can see the overweight, underweight here, a minus 3%, so pretty much in line with market cap for Taiwan. A very large overweight for the Pacific region, and that's for Korea, South Korea obviously, and Brazil, slight overweight, underweight in India. So you can see these are the active tilts in the portfolio. They like EM Pacific and they dislike China. So there's their underweight. So that's the way I'd analyze it. And then just think, well, do I trust the managers? Are they worth the fee, the additional fee, which is going to eat up 0.5% of your return every year? Can they add an extra 0.5% of return due to their skill in stock selection? So that's how I'd compare the two. And personally, I'd probably go for the passive one, but that's just personal preference. And it's kind of based on active outperformance statistics. Although those are all good active fund managers, I'd trust certainly Bailey Gifford. And yeah, good. So let me just switch back to questions and hope that answered your questions. That's how I'd approach it. Next question. Oh, one about bonds. Okay, so Thomas Cruz says, it's looking like holding bonds with yields so low is saying you're willing to take a guaranteed loss for the sake of diversification. Is cash really a better option for fixed income allocation? Well, cash is just zero duration bonds. So if you have a bond with 1 year duration, then it's pretty cash-like in terms of return and risk. If you extend the duration, then you're taking more volatility risk because it's more sensitive to inflation rising or yields rising or falling. So that's the way I think about it. Are you getting no income at all? I think that's not true. In fact, even Germany now has a positive real yield on some of its bonds, which hasn't been the case for several years now. And in the US, we now have yields at 1.7%, the 10-year. So while that was true even 6 months ago, yields were 1/3 of what we'd get now. It's no longer true that government bonds are giving you very little income. They are giving you higher income. And that's part of the reason why valuations have normalized for growth stocks, which is that risk-free assets or very low-risk assets are generating higher incomes. So that's moved money out of the risky assets more into safe assets. So that's why I don't agree that you're going to take a guaranteed loss. I think that's unlikely. But the reason for holding bonds is not for the capital gain. It's because of the equity hedging. If equity markets crash, then bonds are a form of hedge where you're paid by the government to hold the hedge. If you were to buy protection with a put option, you'd have to pay the premium all the time. And it can be very expensive and it can be a massive drag on your returns. Whereas with a treasury, you're being paid to hold the hedge. And it has been very reliable as a hedge historically. If you look at every single year where there's been a fall in the S&P 500, over the period since 1960, there was only 1 year in which treasuries fell at the same time as equity. And they only fell by about 5%, I believe. So in terms of capital preservation, they're very good. And for crash protection for equity, they're also very good. The correlation varies. It's often negative, not always negative. Sometimes it goes positive. But during a crash, when people are scared, you bet they're going to buy treasuries. It is a safe form of investment and the capital's protected. So I'd be clear about why you're buying government bonds. And if you don't want the hedge, if you're investing for a long period of time and you're willing to ride out the volatility, then yeah, you don't need it. And cash is another alternative. But if inflation is going to be rising, then cash becomes less attractive. You do want some kind of income where you're going to offset some of the losses due to inflation. That's probably going to be better than cash. And you can always go for inflation-linked bonds if you think inflation will exceed the break-even over the life of the fund, over the duration of the fund. Okay. Any other super chats or?
There's a member's question.
Members' question.
I'm literally just.
Okay. Time to feed Teddy another treat, I think. Here we go, Ted. Are you ready, my friend? Oh, you don't rest on me. Go on. Go on. Over here. Over here. That's it. You walk over. Walk over. Oh, good boy. Up again. Oh, Teddy. Good boy. You're very good. You clever lad. Right. So the question is from Andrew O'Connell. Thank you for supporting us, Andrew, who says, noob here. Is no problem with that. Is the recent 3 days of stock falls something that happens regularly? Also, I don't understand why the inflation thing is freaking out investors. Seems expected to me. Yeah, I think 3 days of stock falls is not unusual. I mean, I think what really started this off recently for this sell-off is Janet Yellen made a comment a couple of weeks ago when she said that if things are overheating in the economy, it may be appropriate to raise interest rates. And it was literally just one sentence during a long conference, but markets completely freaked out, even though she's not the person to set interest rates anymore. So it was literally just a throwaway comment. And there was a big equity sell-off as a result, and particularly in tech or growth stocks. So I think markets do tend to overreact. It just shows you at the moment that people are nervous because they look at valuations, they see they're extremely high, and people get scared. You know, when you see very large growth in your portfolio, you want to hold on to it. People don't think, you know, I'm up 100%, I don't care about a 5% loss. We always anchor relative to our most previous, you know, highest previous peak. And people are scared about losses. And I think people also see the writing on the wall that if interest rates are higher, you can't really justify such crazy valuations for some stocks. And that's why we've seen funds like ARK Invest have very large falls from its peaks in February. So, yeah, I think 3-day stock falls are just kind of part and parcel of the market. Really, I mean, if you're the ideal bond investor, I did a podcast recently with Bushy. Is Bushy Martin, isn't it? Mm-hmm. Bushy Martin, a really nice guy who does a podcast and has a website in Australia. And one of the things he picked up on, which I said, was the best investors are dead investors. Why is that? Well, they don't fiddle with the portfolio. And this was based on research that Fidelity had done. And I'd first heard of it from Jim O'Shaughnessy, who did manage to confirm it, but he just heard it from someone at Fidelity. But it makes sense because if you do fiddle with your portfolio, every time there's a crash, you sell, then ultimately you're going to lose money. Whereas if you just leave it in the equity market and don't fiddle with it, you'll probably get a very good outcome. So dead investors, you know, are usually very good investors, probably better than alive investors, you know, living investors. So that's the way to think. You know, have a dead mindset. Or the way I put it was the Teddy strategy, because Teddy generally he sleeps most of the time. But then, you know, when equity markets fall, that's when you become very active, and that's when you buy. But over most of the time that you're invested, you don't do anything. You just sit there and let compounding work its magic with the equity portion of your investments.
Put the interview link in.
Put the interview link in.
Bushy. I'll put the Bushy.
Oh, okay. Laurie. I can hear a voice. Laura says she's going to put the Bushy Martin interview link into the description if you're watching this in replay, or even if you're not, afterwards you can have a look. Brilliant. Right, so next question is, I guess, about inflation. Your point about inflation, which is that it's freaking out investors. Yeah, that was what the video was about today, the kind of impromptu video that we shot and released in a day. And I think I'll probably do more of those because I think it's kind of fun to do the kind of more up-to-date stuff. But I agree with you that people were expecting inflation to go higher, but I deliberately made a video saying, yes, inflation will go higher, just to kind of almost vaccinate people against the fear of inflation, because you can bet that people will be saying the world's ending, we're getting hyperinflation. There are many people who have a kind of agenda where, particularly gold investors and crypto investors who want to say that fiat currency is worthless and it's going to get inflated away. So, for those people, the narrative is that, the world's ending when inflation goes to 4.2%, but it's really not. And it was expected. And I still think there are clear signs that many of the components will be short term, that spike. So, yeah, I think markets overreacted, but that's often the way. But use that to your advantage. You can arbitrage people's fear by reacting in the correct way, which is when there is a sell-off, you buy more. Okay, that's the way to make money. You can always arbitrage people's nature because that's the last thing that is arbitrageable. We don't have access to information which is available only to us because that's illegal, that's insider trading. So the only way you can have an edge in markets is to arbitrage human nature, because people get scared or they get exuberant, and you can make money both sides. So yeah, I'd say that is expected. It's built into the market, and just make use of that irrationality and overreaction. Okay, Sam Harris says, I feel the current stock sell-off is fueled by 1, inflation fears. True. Sell in May and go away. Yep. And fear of a second, third wave of COVID-19. Would you agree or offer a different perspective? No, I think all of those are part of it. I think many of the people, one way to see this is, imagine a ball of hot money that's entered markets, which is all of the retail investors who are new to markets. And as one market becomes popular, it has huge momentum, like the meme stocks, and then the momentum fades and people kind of give up on that one. And then something else comes along, and then everyone piles into that. It might be commodities, it might be a particular cryptocurrency like Dogecoin. And then, that goes off the boil, and then the money flows somewhere else. And then eventually people will get bored and we'll just go back to the boring grind upwards of markets. But at the moment, that kind of hot money model certainly seems to be fitting the market movements that we're seeing at the moment. And at the moment, that hot money, I think, is fading because people are going back to work. They haven't got the time to spend monitoring the memes and investing in things. So I think that'll probably subside, this kind of huge rallies that we've seen. And also, as interest rates rise, we won't get such high valuations on equity. There will be a bit of a reckoning there. Sell in May and go away. Yeah, flows are low. But generally, when flows are low, in other words, there's less money flowing into equity markets or less trading, that doesn't necessarily mean that markets move down. What it means usually is more volatility, because if there's less kind of active trading, then a few small, large orders can move markets more, and then you tend to see more volatility. So there's usually, a volatile period until about October when everyone's back from their holidays, and then the volatility ebbs a bit, or there's a big correction as people reevaluate their portfolios. And then we kind of go back to service as usual with equity gradually rising. So I think those are probably the reasons. Second and third wave of COVID, I think that's less of a concern now. If anything, COVID's more of a tailwind now certainly in developed markets, not in India. Clearly, it's still a huge crisis in emerging markets, and in particular in India. So, yeah, I don't think COVID is really a good explanation of what's going on. So I think that's probably, inflation, yeah, definitely that's a fear. Increased interest rates, that's the big fear. And, it's very clear that anything that even hints inflation's going up or interest rates will go up, which is effectively the same thing because of Fed policy reaction, then tech sells off. And so those growth stocks are particularly the ones which are most exposed because of their high valuations. And that's why, I think we've seen the things that we have. Okay, so next question is from Andrew O'Connell, who says, thank you, Andrew. Thanks, I did use up my remaining ISA allowance by buying more US index at a lower rate. Good. Although not as much as I would have liked. Okay. Fingers crossed the market goes up again. Yes, let's hope so. So, I'm building up my equity allocation myself. So every second Friday, I get a little reminder that says buy equity tomorrow. Okay, so I got one today. Actually, it's a Thursday that the message comes up. So I'll be buying more equity tomorrow, and I'm drip feeding back into the equity market slowly. So it'll be a 2-year drip feed. And what I'm expecting is we're going to, get a better entry point during that 2-year period. And, I'll put much more into equity if there is a big correction. So however you do it, I think buying when prices fall is generally a good thing. So well done, Andrew, to have that patience. Okay, so let's go back to the questions from non-members. Let's see what we've got.
I've got one from Chestad, and we love Chestad.
Oh, indeed, we do love Chestad. He's very funny.
Okay, since that.
Okay. Investing in ETFs like QYLD, which sell covered calls on the QQQ, is a good idea. There are other similar ETFs, but over other indexes like the S&P 500, they seem to have a high yield. Yeah, so the idea here is that you can take an index like NASDAQ, why not, which has a fairly low dividend yield. So let's have a look at QQQ. Let me just share my screen, and then I can share what Chestad is talking about as well, which could be kind of interesting. There we go. So let's have a look at QQQ, and we'll have a look at the dividend yield for QQQ. And where should we have a look at it? Okay, let's have a look on Yahoo Finance. And am I sharing? I don't think I am I? Oh, yes, I am. Good. Okay, and we can look at the dividend yield, which in this case is 0.52%. So very small dividend yield for this NASDAQ tracker. So wouldn't it be great if you could buy NASDAQ but have a yield of, say, 3 or 4%? How could we do that? Well, if you have an option selling strategy, what you can do is, let's say the price of, let's have a look at the price of QQQ, and let's look at it over a period of, say, 1 year. So you can see it's had a fairly good rally up to March. It's been trading kind of sideways since then. So let's say you don't think it's going to go up beyond about, I don't know, 350. What could you do? Well, you could sell a call option. So you could own QQQ, so you own the ETF, but then you have a call option which kicks in above 350, which means that you don't participate in any of the upside above 350. You've sold the upside because you didn't believe it would happen. Now, someone else will buy that option from you and pay you something for it because they believe it will happen. So you can actually monetize other people's optimism and volatility in markets, because the chance of it reaching 350 is much higher if markets are more volatile. So during volatile periods, you can monetize volatility, but also monetize optimism from other people by selling call options. What does that mean to you? Well, if you sold a 3-month call option, you pocket the premium, which can then be paid to you as a dividend. And then in 3 months' time, you look at the QQQ fund again, and maybe you'll sell anything above 10% above the current price at that time. And then you keep on rolling this strategy over time, and that way you can generate a very high income for any index by selling those upside call options. So let's have a look at QILD, which is a nice example of a covered call fund. And let's have a look at the yield. So remember, the yield on the previous one was tiny, but the yield on this is almost 12%. So you've got exposure to the NASDAQ, but you've sold some of the upside. If that sounds too good to be true, what's the downside? Well, the problem is that if it does rally hugely, you won't participate in the very large increase in the fund. And that's because you've sold that upside to somebody else. Somebody else is going to get that benefit. You will participate in some of the upside, but the further away the call option is from the current price, the less income you'll get from selling the option. The option premium will be lower. So that's the drawback. The other drawback is the expense ratio for these is generally high, because presumably the option overlay requires a bit of work, and hey, they can charge you for it. So 0.6% is the fee for this one, whereas QQQ was much cheaper. So let's go back to QQQ. So instead of 11.7% yield, now you've got 0.52% dividend yield, and the fee is much lower, 0.2% instead of 0.6%. So those are the kind of trade-offs. Higher fee, higher income, but you've given away the upside. That's a drawback with these yield-enhanced funds. And if you're a high net worth investor, then you can talk to your kind structurer at an investment bank, and they will construct a yield-enhanced version of anything you like. You know, individual stocks, individual indices, currency pairs. I mean, anything you want, really. The sky's the limit. But of course, they'll charge you for that. So again, there's no kind of free lunch there. Right. So back to the questions. Any other?
Yeah, they're in Slack.
Okay, right. So we've got some more questions from members. Okay. Ratner says, hi Ramin, good content as always, thank you. What percentage equity exposure will you have when you've finished your drip feed? Which equity funds are you buying? Okay, look, the usual caveat, which is, are you my age? Do you have a startup business called PensionCraft, which is getting better in terms of income, but still not safe? You know, what medical conditions have you got? Are they the same as mine? And what savings have you got? Are they exactly the same as mine? Okay, my point is, my risk appetite, my circumstances won't be the same as yours. Also, I might just be more cautious than you. So, you know, what I go for may not be appropriate for you, but I will answer your question. I've gone for global equity. So there's a global equity all cap fund from Vanguard. I'll probably stop at about 80% equity, and I'll accelerate my purchases if there is an equity market sell-off over the next 2 years, which is fairly likely, but not a certainty. So that's the plan, and I'm forcing myself to do this because I am cautious. But what's happened recently is that the income from PensionCraft has become large enough to, you know, pay for our company and for us to kind of live. So that's been great. You know, we're grateful for that situation, but it's certainly not certain. We would like to scale the company, so, you know, there's always a risk that goes with that. And so, you know, I'm still not out of the woods, as it were. It's just enough to pay for our living expenses and then some. So if we did scale, if we hired anyone else, again, we'd be on shaky ground. So, you know, those are the circumstances. And circumstances, in other words, your risk appetite, how much money you've got, how much savings you've got, are more important in a way than your asset allocation. And they certainly contribute to your asset allocation, but in terms of what you buy and why, that's incredibly important. And it's different for every person. And I can tell you, because I do power hours with people and I speak to everybody from, 60-year-old people to 20-year-old people, people who've sold companies, who are ultra high net worth clients, who've got their own family office, down to, someone who's literally just got £10,000 to invest or even less. And their circumstances are so different and everyone's style is different. So really what you've got to do is just find your own style. And there is no one way of investing which works perfectly for everyone. But there are certain guidelines which work for everybody, which we're always talking about. So if you watch any of our content, you'll have seen those. So yeah, that's the usual caveat. That's what I'm doing. Okay, next question is from Leonard von Nebelschutz, who says, not a member, but you know him from Powers. Indeed. Okay. Yeah, I know Leonard well. He's great. Recently, we had a public statement by the SEC regarding Bitcoin future markets. Now, Elon Musk's move to say that Bitcoin is not environmentally friendly, so they might move to a more environmentally friendly, less polluting crypto, which obviously had a big impact on Bitcoin and other cryptocurrencies, which are down 10% on the news. Momentum about to suffer, cryptos alike, all in favour of the US government's plans. What do you think? Well, I think this is part of growing up, I think, for cryptocurrency, which is that, okay, it's interesting that, people build a narrative around crypto where they say if there's anything negative, it's kind of immediately brushed off. Or if I say things like, I'm not that keen on crypto, people say I don't understand it, which obviously, I have tried to understand it. I've done courses on it, and I've actually bought some. So I kind of get it, and I understand the reasons why people buy it. But do I think that it's a fundamentally good thing, or that it has a fundamental price? If I ever say that something which doesn't give you an income has no intrinsic value, people get very upset, even though it's true. So in terms of government policy, I still think that's the biggest risk to cryptocurrency, and clamping down on tax evasion and also underhand dealings, perhaps put it that way, is something which the government is inevitably going to do. So using it as a way of evading tax or for criminal activity will then become impossible. But it also makes it less attractive, because I think some people don't want to tell the tax office, the Inland Revenue in the UK, the IRS in the US, they don't want to tell them about their very large gains, because why would you, So there's going to have to be an increase in transparency and maybe declaration of all of your crypto holdings, and that makes it less attractive. It's that simple. And if it does start to threaten the US government's ability to control certainly money and taxes, you bet it's going to get legislated. So it just has to grow up, I think. And also the kind of narrative about not polluting is just not true. You don't absolutely need cryptocurrency. It is a polluting thing. And if you imagine two worlds, one in which you have crypto, one in which you don't, and if you do have these expensive proof of work algorithms, then that world in which crypto exists is more polluting than one in which it doesn't. So I don't buy the argument that, okay, fiat money is also polluting, but we need fiat money. That's a critical part of our financial system. We couldn't live without it. But crypto, could we live without it? Yeah. So yeah, I think government policy is very important. And I think I think some of this is healthy, and I think a move to less polluting proof of work is very important. And I think making it more transparent in terms of ownership is a good thing. You shouldn't use it for hiding capital gains because that's just wrong. And it is growing up. That's what I'd say. But as those things happen, you're kind of peeling the onion and just looking at what's left inside. You know, what is left? What is it? What is it giving you exposure to? Is it just a speculative asset? Is it a store of value? So when inflation spiked recently, crypto sold off considerably. And yet people say it's a safe store of value. Well, you know, with 80% volatility, that's not a safe store of value. And when the returns have been kind of flat over the last 3 or 4 months for Bitcoin, the primary argument for using it has gone away. So I think, you know, I kind of like crypto because I'm a nerd, but do I think it's kind of a religion which I buy into? No, I don't think so. And it has to grow up. And these are probably positive outcomes, I'd say, for the crypto market. Okay, so next question. I think we can choose one from here. Okay. So we've got 4 minutes left. We've got one treat left for Teddy. Yes, there's one treat left, Ted. One treat, my friend. Are you treated out? You can stand for one more. Oh, Teddy, that's very good. Over here, over here. Stand up, stand up. Stand up, stand up. Good boy. Very good. Well done. Right, so treats are used up. We've got 4 minutes and one more question. Okay, so do like the stream. That would help us a lot. It's not too late. Only 143 likes and 376 viewers. So please do like the stream. That would help us. And the question I'm going to answer, the last one, is someone's been on a buying spree for Bitcoin, Tesla, and not sure what the other two are. The other two tickers are. That's good. When prices fall, you buy. That's great. And oh, Leonard says thank you for your work. Thank you for the super chat, Leonard. That's really kind of you. Somebody says that Dogecoin is better since it outperformed Bitcoin. Yeah. Yeah. Okay. And Ethereum was actually the Bitcoin, the current cryptocurrency which I bought, so it wasn't Bitcoin. Yeah. Okay, so someone here asking about a China ETF. I have a China ETF, IASH. Why, when the Chinese market is open at UK night time, does the price of IASH vary on the UK market in the day? That's often the case, that if you buy an ETF which exposes you to another market, so let's say you buy an S&P 500 tracker, then the price will vary intraday when the UK market's open, and that'll be based on expectations about what's going to happen to the market when the Chinese market opens or the US market opens. You can sometimes track those market with a futures market, which is open for different trading hours. So you do have a clue what the price should be, but what you'll notice is the minute that market opens, the ETF will snap back into line with the market which it's tracking. And that's because there's an arbitrage trade which the authorized participants can do. So, you know, if equity markets are cheaper in China than the ETF, then they'll sell the ETF and buy the basket of stocks, or vice versa. And that way, that arbitrage trade brings the two back into line. And that's the job of the authorized participants. They also provide liquidity and the creation redemption process. So that's also true for government bond funds or even corporate bond ETFs. They provide a lot of liquidity, sometimes even more than the underlying market. So when we had the big sell-off in bond markets in March last year, then you could actually price bonds better, corporate bonds, from the ETF than you could from the underlying high-yield corporate bond market, for example. So they do provide that liquidity, and they actually provide sometimes better pricing information than the index they track. So let's wrap it up there. just to recap, if you do want to get that Voyant license, just get in touch with us. There'll be instructions in the Patreon post, to which there will be a link in the description. And Voyant is a cash flow modeling tool which we think is very good. And that way we kind of group discount. So please do consider that. It's a useful planning tool for your investments, both in the US and the UK, and I think in Australia. So that's something to consider. And video coming out this Saturday will be about the very large number of companies which actually lose 100% of their investors' capital over their lifetime. So why it's so hard to choose winning stocks. That's what it's about. And we just published a video today on the sell-off in equity due to the rise in inflation. So we dig into those inflation numbers to just give a bit more colour and explain what's going on, which you might find useful. So that's our plans, and we'll see you in 2 weeks' time. And thank you all for joining us. It's been a pleasure to have you on the live chat. Brilliant questions, as always. I'm always amazed by the quality of the questions. Thank you for that. And have a great 2 weeks, and good luck in markets. Take care, everyone.